Welcome to RBC's Markets in Motion podcast, recorded May 7th, 2024. I'm Lori Calvasina, head of U.S. Equity Strategy at RBC Capital Markets. Please listen to the end of this podcast for important disclaimers. 3 big things you need to know. First, after a weak start to 1Q reporting season, it settled into a groove on the stats. Second, we run through our thoughts on key themes on the company earnings calls so far. And third, we highlight what's jumping out on our high-frequency indicators. This includes our main sentiment indicator, which we still think hasn't fallen enough, and our rundown on the key headwinds and tailwinds for small cap, which both weakened last week. If you'd like to hear more, here's another 5 minutes. Now let's jump into the details. We'll start with takeaway number 1. Earnings season settles into a groove on the stats. Last week, we noted that after a weak start, reporting season was starting to find its footing, and today we'd take that a step farther and say it's actually settled into a groove. Here's what jumps out so far on the numbers. It's continued to be a better reporting season from an earnings perspective than a revenue perspective. Our recent stats show that 77% of S&P companies were beating consensus on earnings, while 59% were beating on revenues. Trends are similar for the Russell 2000. The sizable gap we're seeing between earnings and revenue beats has been in place for a few quarters on both indices and suggests to us that companies are doing a good job of managing results to meet or beat expectations. Large cap stock price reactions to earnings beats, meanwhile, have finally turned positive. We're now seeing mostly outperformance among the stocks that have beaten consensus on earnings so far within the Russell 1000, reversing the underperformance that had been seen among the very earliest reporters. Companies beating expectations on earnings are also outperforming in the Russell 2000. The bottom-up consensus earnings forecast for the S&P for 2024, interestingly, has moved up again. This stat is now tracking at 245, up from 242 a few weeks ago and 244 in our last update. And most importantly, old leadership continues to look tired. Our preferred gauge of earnings sentiment, the percent of sell-side EPS estimate revisions to the upside, has been a little bit stronger for value than growth recently. We've also started tracking this stat for the top 10 market cap names in the S&P relative to the rest of the market. Recently, we've started to see a slightly stronger rate of upward revisions, i.e. better earnings sentiment for the rest of the market. And that reverses conditions in place throughout 2023 when earnings sentiment for the top 10 market cap names was much, much stronger. Let's move on to takeaway number 2, our rundown on key themes on earnings calls so far. As our regular readers are well aware, our team reads through as many earnings transcripts as we can to get a feel for key themes. Here's some things that jumped out to us in our reading last week. Perceptions of the outlook, demand, and macro backdrop were mixed, with a number of companies emphasizing better second-half conditions. On the consumer, we really didn't read anything new last week, but we did note that the tone seemed to skew more negatively than prior weeks and the last few reporting seasons. On the cost environment, some noted inflation and pricing were normalizing. On the Fed and interest rates, several companies highlighted the return of uncertainty on this issue and the impacts of high costs of capital and debt. Commentary on China and Europe has been much more mixed, far less negative than what we've seen in the past 3 reporting seasons. And AI continued to be a key theme last week. We have been seeing more of a positive tone recently than what we observed at the beginning of 1Q reporting season on this topic. Now let's wrap up with takeaway number 3. What else is jumping out from our high-frequency indicators? The 2 big ones here this week were small caps and sentiment. On small caps, they've been sandwiched between strong headwinds and tailwinds, and both of these seemed to weaken last week. Despite the tough April that small caps had amid renewed fears over the path of inflation and the Fed, the Russell 2000 has still not broken to a new low versus the S&P 500, and May's actually been pretty good for small caps on a relative basis. The reasons for small caps' resilience was a focal point in our meetings last week, even before Friday's below consensus print for non-farm payrolls and slightly higher than expected April unemployment, which boosted rate cut optimism. We've been highlighting in our meetings how small caps are simply caught between powerful tailwinds and headwinds, and what to do here is a really tough call. The tailwinds for small caps have primarily been attractive positioning and valuations, along with improving economic expectations. On the latter point, we've highlighted the apparent bottoming in ISM manufacturing and the recent improvement in consensus GDP forecasts, since small caps tend to outperform when ISM manufacturing moves up and once GDP starts to trend above average. The primary headwind for small caps, on the other hand, has been the Fed. Historically, Fed cuts have been triggers for small cap outperformance, but the shift in leadership has tended to occur after the event, not before. Most of the equity investors we spoke with last week, prior to Friday, didn't think cuts were coming anytime soon and worried the idea that inflation would moderate from here was based on little more than hope. While an argument can be made that the Fed headwind for small caps eased a bit on Friday with the jobs report, we think it's equally important to note that the economic tailwinds for small cap also weakened a little bit last week. In our meetings, it was apparent to us that some of the consumer companies that reported last week had heightened concerns among investors about the health of the consumer. And while still off its lows, ISM Manufacturing actually slipped in its update last week and was back in contraction territory. Our bottom line, we wouldn't be underweight small caps right now. There are just too many tailwinds. But we are reluctant to turn overweight in light of these complex cross-currents and would argue that a neutral stance is more appropriate right now. And finally, let's wrap up on sentiment. It still hasn't gotten hit hard enough in our opinion. Over the last few weeks, we've argued that our sentiment indicators hadn't fallen enough to indicate that the current pullback was over, and that's still our view today. We continue to keep a very close eye on the weekly AAII survey, which came into 2024 roughly one standard deviation above its long-term average. That's similar to where it was last summer when the 10% plus drawdown in the S&P 500 started. After falling briefly in recent weeks, net bulls on AAII moved up in the latest update to 6%, while the 4-week average is only down to about 7%. That keeps our concerns alive that the pullback hasn't run its course yet, since this indicator fell to more than one standard deviation below the long-term average last fall, which is around minus 9%, shortly before the S&P established its October 2023 low. That's all for now. Thanks for listening, and be sure to reach out to your RBC representative with any questions.
This content is based on information available at the time it was recorded and is for informational purposes only. It is not an offer to buy or sell or a solicitation, and no recommendations are implied. It is outside the scope of this communication to consider whether it is suitable for you and your financial objectives.